Blockbuster rejects Netflix, 2000.
In the year 2000, Blockbuster was the undisputed king of video rental. 9,000 stores across America, millions of customers, $6 billion in annual revenue. The company was so dominant that Blockbuster Night was part of American culture. Netflix was a tiny startup founded in 1997 by Reed Hastings and Mark Randolph. They mailed DVDs to customers. No late fees, no driving to stores. The business was struggling. They were losing money. They needed help. In 2000, Netflix CEO Reed Hastings flew to Dallas to meet with Blockbuster CEO John Antioco. Hastings proposed a partnership. Netflix would run Blockbuster's online brand. Blockbuster would promote Netflix in stores. The price? Netflix wanted $50 million for the company.
Blockbuster executives listened to the pitch. Then they laughed. $50 million for a money-losing DVD by mail service? Why would Blockbuster need that? They had 9,000 stores. They had brand recognition. They had the market. The meeting ended. Blockbuster executives reportedly laughed at Hastings as he left. The idea of mail-order DVDs replacing physical stores seemed absurd. Blockbuster passed. If Blockbuster had bought Netflix for $50 million in 2000, they would have owned the company that would dominate the future of entertainment. More importantly, they would have owned Reed Hastings and Mark Randolph, the leadership team that understood where media consumption was heading. They would have had the technology infrastructure and customer data that would become invaluable as streaming emerged. Even if Blockbuster executives didn't believe in streaming yet, $50 million was a rounding error for a $6 billion company. The worst case was buying a competitor. The best case was owning the future. The consequences. By 2010, Blockbuster filed for bankruptcy. The company that had been worth $5 billion at its peak was gone. Netflix, the company Blockbuster could have bought for $50 million, is worth over $150 billion today. It didn't just survive, it destroyed the entire video rental industry and transformed how humans consume media. Reed Hastings has publicly said that Blockbuster's rejection was one of the best things that ever happened to Netflix. It gave them the motivation to prove Blockbuster wrong. The last Blockbuster store, in Bend, Oregon, operates as a nostalgic curiosity and tourist attraction, a monument to corporate arrogance. The pattern begins. Market leader dismissing disruptive innovation as irrelevant. Kodak invents digital camera, then kills it, 1975 to 2000s. In 1975, Steve Sasson, a 25-year-old engineer at Kodak, invented the world's first digital camera. It was crude, 0.01 megapixels, recorded to cassette tape, took 23 seconds to capture an image, but it worked. Sasson showed his invention to Kodak executives. He explained that this technology would eventually replace film. He demonstrated a working prototype. Kodak's response? They told him never to talk about it again. Kodak executives understood exactly what digital photography meant. It would destroy their film business. And their film business was spectacularly profitable. Kodak dominated film sales globally. Film was a recurring revenue dream. People bought film constantly, developed it regularly, paid for prints and reprints. The margins were incredible. Digital photography threatened all of that. If photos were digital, people wouldn't need film. They wouldn't need development. They wouldn't need printing, or would print far less. Kodak's decision was deliberate. Suppress digital photography technology. Don't develop it. Don't market it. Protect the film business as long as possible. They filed patents on Sasson's invention,
but only to prevent competitors from using it. Kodak sat on digital photography technology for decades. Kodak could have led the digital photography revolution. They invented it. They understood the technology. They had the brand, the distribution, the expertise. If Kodak had embraced digital photography in the 1980s or early 1990s, they could have been what Apple, Sony, and Canon became, dominant players in digital imaging. They could have transitioned their business before competitors destroyed them. Yes, it would have cannibalized film sales, but someone was going to cannibalize film. The only question was whether Kodak would cannibalize itself or wait for competitors to do it.
The consequences. By the early 2000s, digital cameras from Sony, Canon, and Nikon were everywhere. Smartphones with cameras began appearing. Film sales collapsed. Kodak finally tried to compete in digital, but they were too late. Competitors had taken the market. Kodak's digital cameras were unremarkable. They had no technological advantage, despite inventing the category. In 2012, Kodak filed for bankruptcy. The company that invented digital photography was destroyed by it. Today, Kodak exists as a tiny shadow of its former self, licensing its brand name. A company that once employed 145,000 people now employs a few thousand. Steve Sassen's invention sits in the Smithsonian. The camera that could have saved Kodak instead became a museum piece documenting corporate failure. The pattern continues, protecting legacy business over embracing inevitable change.
Excite turns down Google, 1999. In 1999, Google was a Stanford research project run by Larry Page and Sergey Brin. They'd built a better search engine using PageRank algorithm, but they wanted to get back to their doctoral research. They approached Excite, one of the leading web portals at the time. Excite had search functionality, but it wasn't their focus. They were trying to be a web portal with news, email, and other services. Larry Page offered to sell Google to Excite for $1 million. When Excite showed limited interest, Page dropped the price to $750,000. Vinod Khosla, a venture capitalist and Excite board member, tried to negotiate even lower. He offered $750,000, but wanted some conditions. Excite CEO George Bell ultimately rejected the deal. Excite's CEO thought Google's search was too good. This sounds absurd, but the reasoning made sense from a 1999 portal perspective. Excite wanted users to stay on their site, clicking through pages, viewing ads. If search was too efficient, users would find what they wanted and leave quickly. Google search got users to their destination too fast. From a page view and ad impression perspective, this was bad. Bell also believed Excite's brand and traffic were more valuable than search technology. People came to Excite for the portal experience, not just search. Why spend $750,000 on technology that might undermine the business model? Excite passed. If Excite had paid $750,000 for Google in 1999, they would have owned the technology that would dominate internet search for the next quarter century. Even if Excite's management didn't understand Google's full potential, they could have run it as a separate service, or sold it later for vastly more, or used the PageRank technology to improve their own search. $750,000 was nothing for a company with a market cap in the billions at the time. The consequences. Google, rejected by Excite, secured venture capital funding and launched as an independent company. By focusing obsessively on search quality, they built the best search engine on the internet. Google went public in 2004 at a valuation of $23 billion. Today, Google, now Alphabet, is worth over $2 trillion. It's one of the most valuable companies on Earth. Excite merged with At Home, went bankrupt in 2001, and essentially disappeared. The Excite brand still exists, but only as a minor web portal owned by IAC. George Bell, the CEO who rejected Google, left Excite before the bankruptcy and moved to other ventures. The rejection of Google became one of the most famous missed opportunities in tech history. The pattern: established player failing to recognize transformative technology.
Yahoo rejects Microsoft's $44.6 billion offer, 2008. In February 2008, Microsoft made an unsolicited offer to acquire Yahoo for $44.6 billion, $31 per share in cash and stock. This was an enormous premium. Yahoo stock had been trading around $19. Microsoft was offering 63% above the market price. Yahoo's board, led by CEO Jerry Yang, a co-founder, had a decision to make: accept the massive payday or reject the offer and bet on Yahoo's independent future. Yahoo's board rejected Microsoft's offer. They believed the company was worth more than $31 per share. Jerry Yang publicly stated that the offer substantially undervalues Yahoo. The board insisted they had a plan to increase value independently through advertising partnerships and improved products. Yang believed Yahoo could compete with Google in search, dominate display advertising, and leverage their media properties to grow revenue. The company's plan projected significant growth. Microsoft increased their offer slightly. Yahoo still said no. Negotiations dragged on for months, then collapsed completely. If Yahoo had accepted Microsoft's $44.6 billion offer in 2008, shareholders would have received a massive premium on a company whose best days were already behind it. Yahoo was already losing ground to Google in search and to Facebook in social media. Their portal strategy was becoming obsolete. The writing was on the wall, even if management refused to see it. The $44.6 billion offer was Yahoo's exit at peak valuation. They would never get a better deal.
The consequences: Yahoo never achieved the growth their projections promised. Google continued dominating search. Facebook ate their social and advertising business. Mobile disrupted their remaining advantages. Yahoo's value declined steadily. The company cycled through CEOs, strategies, and restructurings. Nothing worked. In 2017, Verizon acquired Yahoo's core business for $4.48 billion, 90% less than Microsoft's 2008 offer. Jerry Yang, who led the rejection, stepped down as CEO in 2009. The Yahoo board's decision to reject $44.6 billion became one of the most expensive mistakes in corporate history. Shareholders lost approximately $40 billion in value by waiting 9 years to sell for a fraction of what Microsoft offered. The pattern: overconfidence in a declining business, missing the exit window. Xerox PARC invents the future, gives it away. 1970s to 1980s. In the 1970s, Xerox established PARC, Palo Alto Research Center, to invent the future of computing. They hired brilliant researchers and gave them freedom to innovate. PARC researchers invented technologies that would define modern computing. The graphical user interface, GUI, with windows, icons, and menus. The computer mouse, Ethernet networking, laser printing, object-oriented programming. These weren't incremental improvements. These were revolutionary inventions that would enable the personal computer revolution. Xerox had invented the future. Then they did almost nothing with it. Xerox management viewed PARC as a research center, not a product division. The company's focus was copiers. That's where the money was. Computing research was interesting, but copiers paid the bills. When PARC researchers demonstrated their Alto computer, featuring a GUI, mouse, and networking, Xerox executives didn't see how it connected to the copier business. It was too expensive to manufacture. The market wasn't ready. It didn't fit Xerox's business model. Xerox filed patents on some inventions, but didn't aggressively commercialize them. They built limited numbers of Alto computers for internal use and research, but never mass-produced them. In 1979, Xerox allowed Steve Jobs and Apple engineers to tour PARC in exchange for allowing Xerox to invest in Apple. Jobs saw the Alto's GUI and mouse interface. Jobs later said, they were copier heads who had no clue about a computer or what it could do.
If Xerox had commercialized PARC's inventions aggressively, they could have dominated personal computing before IBM and Apple. They had the GUI, they had the mouse, they had networking, they had laser printing. They had everything needed to build the future of computing. Even if Xerox didn't want to become a computer company, they could have licensed the technologies aggressively and collected billions in royalties. The consequences. Steve Jobs took what he saw at PARC and built the Macintosh. Apple commercialized the GUI and mouse, making them accessible to consumers. Microsoft saw the Mac and built Windows, eventually dominating PC operating systems. Xerox did successfully commercialize laser printing. That became a significant business, but they missed the larger computing revolution entirely. By the 1990s, Xerox was struggling. The copier business faced fierce competition. They'd invented technologies worth hundreds of billions, but captured only a tiny fraction of that value. PARC still exists and continues research, but it's now separated from Xerox. The parent company has shrunk dramatically and no longer represents innovation leadership. The phrase "pulling a Xerox" became business shorthand for inventing something revolutionary and failing to capitalize on it. The pattern: inventing the future, but organizational structure and culture preventing commercialization. Nokia dismisses the iPhone. 2007. In 2007, Nokia dominated the mobile phone industry, with roughly 40% global market share. They sold more phones than anyone. They were the undisputed leader. In January 2007, Steve Jobs announced the iPhone. Nokia executives watched the presentation. They analyzed the device. They made their assessment. Nokia executives concluded the iPhone was not a serious threat. Their reasoning seemed sound. The iPhone was expensive, $499 to $599. It had no physical keyboard. It was only on one carrier, AT&T in the US. The camera was worse than Nokia's best phones. It had limited battery life. Apple had no experience in the mobile phone business. Nokia CEO Olli-Pekka Kalasvuo and other executives believed the iPhone was a niche product for wealthy early adopters. Nokia's strength was volume, selling hundreds of millions of affordable phones globally. Nokia had Symbian OS, which ran on millions of devices. They believed their software ecosystem was sufficient. Nokia decided to continue their existing strategy: incremental improvements to feature phones and Symbian-based smartphones. Nokia completely misunderstood what the iPhone represented. The iPhone wasn't just a phone. It was a computer in your pocket. It had a full web browser. It had a touch interface that made mobile internet actually usable. The App Store, launched 2008, created an entirely new software ecosystem. Nokia focused on hardware specs: keyboard, camera quality, battery life. They missed that the iPhone was a platform shift. It wasn't about having the best camera or longest battery. It was about reimagining what a phone could be.
Within 2 years, iPhone and Android smartphones were clearly the future. Nokia's Symbian OS was clunky and outdated by comparison. Nokia tried to respond. They tried to improve Symbian. They partnered with Microsoft on Windows Phone. But they were too slow, too late.
The consequences. By 2013, Nokia's phone business had collapsed. The company that once held 40% market share was in freefall. Microsoft acquired Nokia's phone division for $7.2 billion in 2013. The division was eventually written off as a failed acquisition. The Nokia phone brand essentially died. Nokia as a corporation survives in telecommunications infrastructure, but they're no longer a consumer brand most people think about. The executives who dismissed the iPhone watched their company's market value evaporate from over $100 billion at its peak to a fraction of that. Nokia's collapse became a case study in how market leaders fail to recognize paradigm shifts. The pattern: market dominance creating blindness to revolutionary change.